What's going on, everybody? It's your boy Dominque Williams, aka Mr. Back to the Money, guys. And this is the Don't Overthink Entrepreneurship and Real Estate podcast, man. And I got an amazing guest on, man. I've been on tons of real estate podcasts and seen this man drop gems on the tax benefits of being in the real estate, investing into multifamily like I am. And so many others, man. I just had to get him on to be able to share some of his expertise in this space so you guys can learn all of the great tax benefits and great strategies. So before I actually turn it over, I will, give you some info on Mr. Larry. Mr. Larry has been a CPA for over 10 years with over a decade of experience in tax consulting, preparation, cost segregation studies, accredited investor validations, accounting, auditing, and bookkeeping. His team consists of over 5 tax accounting professionals servicing over 200 plus professionals in real estate across the U.S. He also has 7 years of experience in real estate investing himself, man. But I'm not going to, spill all the beans. I know that he could tell his story way better than I can. So with no further ado, I'd like to introduce you guys to Mr. Larry Pentathlon. How you doing, Larry?
Appreciate it, Donnie. Thank you for having me.
Yes, sir, man. It's great to have you on, man. Finally. Can you share some of your information about, you and your background, man, and why do you choose this profession?
So as you mentioned, I've been a CPA for over a decade. Kind of knew that I was going to go down that path for a while. Just kind of the traditional, go to school, get a job, all that. But I mean, just accounting and numbers is something that kind of just kind of clicks with me from a personality standpoint. But as you're kind of going through helping a lot of different clients, you start to see your W-2 clients, and you start to see your investor clients, and in situations where my investor clients makes twice as much as my W-2 clients, they pay less in taxes than my W-2 clients. So you start to kind of dig in further and kind of learn more, and that's when I kind of knew the position that I was in the public accounting world. I really wasn't serving doing anyone any justice or adding any value. I was just cranking out tax returns, which is a valuable service to provide. It's just there's just so much more that the everyday person can take advantage of that the wealthy can take advantage of. So me kind of stepping away from public accounting, starting PC Financial Services with my partner Terry Conyers, so that we can provide value and consultation to more and more people. And then as we start to kind of dabble into investing ourselves, I always knew the benefits of taxes in real estate. Just then kind of digging further and making that our niche, especially over these past 3-4 years, definitely opened up my eyes to even more value that we can add to our clients. So our motto now is that our mission is to help people achieve financial freedom through real estate investing and tax planning and tax strategy. So we don't see that happening without one or the other, because tax is probably one of people's largest bills on an annual basis. So we can reduce that and help people grow wealth. It's a win-win for everybody involved.
That's a great question. Now, I hear you mention over the last 3 to 4 years, you really seen the benefits there. What are some of those benefits that you've seen over the last 3 to 4 years that make you really to dive deeper into it?
It was more so of not being a jack of all trades. Most accountants, you get grounded up. People hear about tax seasons and all that, and yeah, you get ground up, chewed up, spit out, and you're either going to stay doing that or you're going to start your own thing. But then, when we first open up PC Financials, roughly 9 years ago, we kind of did the same thing. We were just taking on all clients from that standpoint. So it kind of, once again, create another job where it's okay, we're just cranking out tax returns. Where it's okay, we need to kind of step away, really dig deeper into all the little nooks and crannies, because the 3 letters behind my name, none of the stuff that I consult my clients now was part of that CPA exam. And it's impossible to. It's a very long test. It covers multiple areas, but you have to do more research and studying on your own, and then know how to apply it. So to be able to kind of take 1031 exchanges where you're selling a rental property at one, and then you're buying another one, or using the gains off of that one to buy another one, so that you're not taxed, or you're kicking that tax can down the road, is a huge one. Or doing S corp elections for not only our tax business, but the part of our real estate business where we're doing more flips, where we're trying to offset self-employment taxes. So like even the entity structure, and making certain elections play a huge role into that. And then since 2017, with the Trump tax changes, part of that with 100% bonus appreciation from 2017 to 2022. But now being at 80%, like people are now still saw a lot of benefits of that over this past half a decade, and leveraging cost segregation studies, which has their benefit even without the bonus appreciation, but it just added fuel to the fire from that point. So just 1031s, any structures, cost segregation studies to maximize bonus appreciation. Definitely three of the top things that real estate investors need to be mindful of as whether they're picking their tax advisor or doing their own taxes or looking at the next property. Like these are all things that you have to consider, plus many more as well. There's so many doors because the tax code itself was created for business owners and landowners. It wasn't made for employees. It's nothing that's new. It's always been that way. And as soon as you accept that as the truth, you can then start to move appropriately to build wealth and save on taxes.
That makes a lot of sense, man. So with a lot of my investors, some of them new, most of them are new. You know, you already get some that's already active in the real estate space, but a lot of passive investors are looking to somewhere to park their money. So what are like some of the benefits of them passively invested into multifamily that can really save? Because like I said, a lot of them are high net worth business owners, and just probably get ate up in taxes and other assets that they may have in. What is the benefits for them to be able to invest into real estate, such as multifamily?
Real estate in general, especially rental real estate, where you have depreciation, which basically saying the IRS knows that properties wear and tear over a certain period of time. So instead of being able to write off the full purchase price of the property, which would be great, you can take a percentage of that property over a given period of time. And even so much where any income that's made from that property, after all operating expenses, depreciation then comes in, may possibly wipe out all the other income. So you're the one of the best benefits of real estate and rental real estate is that you're not being taxed on all the income that you're making on that property itself. So you're able to kind of shield some of your capital that you make it within there. The other aspect that people will hear about using using potential losses from rental real estate to then offset your W-2 or your business income. That one is a little more convoluted, depending on if you're a real estate professional, you or your spouse can qualify as a real estate professional, or the type of investing that you're getting into. Whereas, okay, it may be multifamily, but is it all multifamily short-term rentals, where it's considered commercial property by the IRS, and then you're not having to be a real estate professional. You just have to prove that you're actively involved. But as a passive investor, you'll come across a little bit more hurdles. It's just depending upon how big of a investment group that you're investing in. Are you fully passive from that standpoint? Can we prove opportunities too? That to prove that you are actively involved, or can prove material participation? Or even where it's like not even within real estate itself, where it's like, hey, like, does this make more sense in a different asset class as well? So we try to make sure we're flexible, knowing that there's many barriers that you may have to cross as a passive investor and using tax losses from rental real estate to offset your W-2 or whatever you're making your money from. But like there's opportunities there. It's just, okay, let's make sure we find the right door to walk you through.
That makes a lot of sense. Because I know a lot of my investors, wanting to know why, and I'll be trying to, explain to them why this is a great vehicle to invest in.
What ends up happening a lot is that we get a lot of calls from passive investors, like, hey, I got this huge K1 loss from the syndication that I'm in, but then like I'm not able to use these losses. And the problem is not that they can't use the losses, that it just hasn't been properly explained to them of when they can or when they can't, because you may not be able to use those losses the first year, but when that property goes full cycle and they sell it, you can then use the losses then to help offset some of the capital gains and depreciation recapture that you end up benefiting from throughout the year. So it may not be a day one, it's just a timing aspect of it, or it's just like, hey, just be mindful that we may have to kind of use other strategies to get your tax bill lower or mitigate your tax liability, as well as strategizing on when these losses may become active, depending on when the operators go full cycle.
Okay, great. So like me, being on the active side, if doing business with you, so when my passive investors come in and I get them their K1 and I just say, hey, I'd rather for you to work with my CPA, the passive investor can come straight to you and get more educated on that part of how their process go, or how does that work if I want to send my investors to you, because, like I said, I know you, like you, and trust you, and I would like for them to work with you. What is that approach?
Yeah, when we're blessed with those type of opportunities, we may even just provide that service to the syndication as a whole, where it's like, hey, for percentage of equity, we'll provide the tax consulting, tax providing service for not just the syndication, but for the LPs that may be interested in utilizing our services and kind of helping them kind of walk through, like, hey, here's what this K1 is saying. And why and what these numbers mean from that perspective there, because I think when people are fully educated on whatever the subject matter is, they operate differently. From my experience from there, or they invest differently, or they may want to do re-up with that same investment group on the next one, because they're using these gains to then reinvest and have that cash flow coming back through again. So it's just kind of talking that through, making sure we're in line with what their goals are. If their goals are also aligned with that operators, then okay, it becomes a easier marriage to kind of merge together at that point.
Okay, that's great. So a lot of my listeners are newer investors. That's why I created Don't Overthink Entrepreneurship, because it was a time where I used to overthink this thing, man. I used to say, I got to have millions of dollars to invest into multifamily, which is true, but it doesn't have to be my own money. So I like to educate and to share with people like you that know the business, to help them to feel a lot comfortable. So for, let's say, new active investors to the space, when should they get a CPA? When should they come to you to start their journey? Let's say if they don't have an investment, what should they do? When should they come to you for your services?
From the very beginning, and it's not all about the tax filing and preparation. Sometimes it's just consulting, where like you definitely want to make sure that, because a lot of times if you don't have an investment, like I said, doing your tax return is rather basic and simple, and it doesn't make sense for me to come in and charge you these fees for something where you can easily get done cheaper at H&R Block or yourself with TurboTax, whatever. From that standpoint, like they're not my competition. I'm more into the consultation and the more heavy duty stuff, so that you're building that rapport. Your tax advisor then knows what you're kind of looking to do, so that it's not just starting from the break once you start having investments coming in. Like you already kind of know what to be on the lookout for, especially for passive investors who may be okay. They can put $25,000-$50,000 into a deal. Okay, know what you're kind of looking into. Here's what this operator is saying, but from the tax perspective, here's how it's going to look. Especially when you're talking, a prime example is preferred returns, and if you're just kind of new to it, if someone's saying, hey, you're getting these guaranteed payments, no matter how the property is operating, called preferred returns, what they don't realize, like, hey, that's still taxable income itself, and any losses that the property does generate does not offset that, because it's the preferred returns are active income, and the losses on the property are considered passive, and they don't typically automatically offset, once again, unless you qualify for certain things like real estate professional status there. So it's conversations like that where it's like, okay, getting the lingo in, knowing what people are trying to say, knowing people are trying to just BS you on some stuff just to kind of get you to invest, and also just not investing into a bad deal for the sake of the tax savings. Like I said, though I'm an investor first, and if the deal doesn't cash flow, I don't really care about the tax savings, because that's a 1-year thing possibly. I got to deal with this investment much longer than that, and it's going to cost me a lot more money than whatever tax savings I'm going to get if it ends up being a headache. So first, like I say, don't let the tax tail wag the investment dog. But having that financial team, like whether you're utilizing everyone's services up front, where it's like, okay, it may cost a couple of $100, but that's going to help save you $1,000 once you start investing. Another example is, okay, if you're a married couple, depending on which state you're in, if you're buying properties, I'm in Virginia. If you're starting a partnership with your spouse, I mean, you got to file a whole separate business 1065 tax return. You don't have to do that in certain states where they got community property states. I can't ever remember the exact states, but they're mostly on the west, Midwest, and West Coast. But it's okay if you didn't know that and you start this partnership with your spouse, and okay, why now we got to pay for 2 separate tax returns, where you could have just done a single LLC, have everything reported on your personal tax return, save on those tax prep costs, like. And then that's me telling you at my detriment, because I don't get to file extra tax return. But it's being transparent and honest, which is how you build relationships with people.
Absolutely. So how do you qualify as a tax professional once you get into the real estate space?
It's rather a low bar entry, to be honest with you, because I mean, you can be a CPA, but I mean, you could be a CPA but specialize in audits. You could be a CPA specialize in everything else but taxes. Like, I consult other CPAs who don't do their taxes because that's not what they got what their specialty is from that standpoint. So just because someone has 3 letters behind their name doesn't mean they fully understand the tax code to the benefit of the person they're working with. So it was important not to let that like cloud your judgment. And then you got your enrolled agents, which is the highest level of certification from the IRS that someone can have. But once again, the tax code itself is so many different angles and avenues where it's like, okay, do they know the taxes to the niche that you're doing? I say I focus primarily on real estate. If you're asking me about tax saving opportunities, about crypto, I could probably scratch the surface, but like I'm not going to be able to know the nitty gritty as someone who has kind of spent that time. So it's really, and so you may have someone who has no certification who just likes reading up on the tax code, and they could be a tax professional as well. It's just being cautious and having those discussions. And like I say, it should be a 2-way street interview where they're trying to make sure it's a good fit for them, and you kind of get an idea, okay, does this person know what they're talking about, and they're a good fit for you as well. So it's all about having that back and forth, and it's all healthy when it's all said and done.
Right. So I think more so my question is like for for the investor, such as myself, how many hours? I think it's a certain amount of hours that I got to have to qualify as a tax professional. I mean, not a tax professional, as a real estate. I'm sorry, a real estate professional. That's why I messed the question up. Yeah, a real estate professional. How many?
Well, no, I mean both are good questions from a tax professional. So if you're trying to qualify as a real estate professional, it's not so much of a, hey, that's my wife Whitney. There.
No problem. Hey.
So it's a time requirement. So it's not so much dealing with like certifications or anything. It's, hey, are you spending at least 750 hours in a real property trader business that you own at least 5% of? So, for example, I own a tax business that primarily serves as real estate professionals. None of my time spent in that business qualifies for real estate professional status because it's not the real property. It's all about the paper and the numbers. So really, we were talking about professions that qualify: construction, property management, leasing agents, like real estate agents, real estate brokers. Those are the type of hours that are qualified. So you got 750 hours, and it can be a combination of those different areas plus more. And it is more than half your work time. So if you have a full-time W-2 job, it's going to be tough for you to prove that you're a real estate professional because the IRS deems that the average person with a full-time job works 2,018 hours a year. And now you're going to sit here and tell the IRS that you work 2,019 plus in real estate, plus sleeping, plus eating. Like 4,000 hours in a year is a lot. So you have to be tracking your time, making sure it's all legit and good to go. And then we get into, are you materially participating with the real estate that you actually own? So you can do property management for others and get real estate professional status, but if you're not putting in time into your own properties, like a lot of these happen to my real estate agents and my contractors, where they get reps, but they don't get material participation because they're not actively involved with a rental property that they own. And there's multiple qualifications for material participation, one being 100 hours and more than anybody else. Another one is 500 qualifying hours. And another one is that you just kind of do all the work yourself. And those hours are entwined with real estate professional status hours. It's just hours related to your property versus hours related to the industry itself. So, like I said, kind of bit to digest, but we do a lot of coaching with our clients and provide spreadsheets and stuff that they can kind of know how to track their hours, what hours to look for, what hours don't count. Education hours typically is a no, especially if it's just kind of going to a random real estate conference and it doesn't really qualify from that standpoint. So it's just, like I said, it's stuff like that where we try to shed some light on so that it's a little more easier to understand.
Yeah, that makes a lot of sense, man. It's good to know because, I think the important thing, like you said, is, someone new needs to, talk with you in the beginning because they can probably be getting some type of benefits, early on before they even get a deal. Like me, I'm investing in, to my podcast and, I'm looking at deals and stuff like that. And I don't know what I don't know. So I think, like you said, it's super important, definitely, to reach out to you in the beginning so you can kind of know, start preparing yourself and, be on schedule, when it's time to start locking up properties and knowing whatever benefits you can get in the beginning. So that's great advice. And another thing I like that you said that you actually educate your clients, versus me coming to you, for your service and not knowing. You're coaching me and letting me know the things that I need to know. And I think that's super important to working with a good CPA, man. I like that. I like that a lot. So the next question I got is how are the wealthy using these tax benefits, such as Donald Trump? A lot of people, up in the air about Donald Trump. I think Donald Trump is an amazing businessman. how is it that he's able to capitalize off real estate to get all of these tax breaks that a lot of people just not educated, they don't understand. They're like, oh, he ain't paying no taxes and such and such. What are the things and strategies that he's using that you're knowledgeable about that that's helping investors and people that's starting to invest into real estate?
Yeah, and I know most people probably, like I say, when you look at Donald Trump's tax return, like I said, it's tough to dissect quite a bit what's going on because he has a lot of K1s from other businesses that's reported. So the actual the losses and all that stuff that people are seeing, like we don't really see where they're coming from, and so it don't really indicate. And so people like to turn, like, if they having these losses, he must be a bad business person. But like, it's not the business operating. That's the term. Like, that's not what the tax return is saying. The tax return is saying that they have these losses, and what ends up happening is that there's a lot of paper losses, and that's where depreciation comes in. So they kind of tie back into what we were discussing earlier, where it's like, hey, he, like, before becoming president, he qualified as a real estate professional because that's what he's known for. He has other businesses, but he's known for just being heavily involved in real estate. So that when he takes advantage of something like that or has that status in place, so let's just say he bought $1 million, or let's say he bought a $1.2 million rental apartment building, for that standpoint there. So the part that we have to back out that he has to do is the land portion, because you can't depreciate land. So let's say he has to back out $2 million for land, and now we just have $100 million basis, and that will be in normal circumstances he'll be able to take that by 27.5 years and divide that $1 million up and recognize that deduction year after year after year, without because most likely he didn't pay $1.2 for. He most likely got a loan for it, probably raised capital from others, so he's able to still take advantage of this deduction without having to put any money into the deal, which helps preserve his wealth from that standpoint there. So now we have this $1 million asset. Now we implement a cost segregation study. We're saying, like, hey, we got this $1 million cost basis. Not all of this within this apartment building is 27.5 years. Like, the roof may last that long, but not the appliances, not the ceiling fans, not the vanities. Like, those may be 5 years. If he has a pool in a parking lot, those are 15-year property. So already we're able to accelerate depreciation quicker and recognize more deductions in the first earlier years, because you're now you got everything in an appropriate bucket. And at that point, if he bought the property, let's just say fourth quarter of the year, and he's applying these strategies, so he most likely didn't have much income coming in the last quarter of the year as the property is probably being renovated, or some of the units are. But now he's able to have a net loss from his property, not because it's operating poorly, it's because he's leveraging these tax strategies to offset his income and then show this loss. And then the real estate professional status now says, okay, now that you're actively involved in real estate, you can then take these losses and then apply these to your other business income, properties that are showing income, or if he is getting a W-2 from one of his businesses, or his investments as well. So that's how they're able to kind of take, that's one example of how you can take the property itself and generate a whole bunch of losses from it, and then use those losses to offset all the income from the property, show a tax loss, not an NOI loss or a net operating loss, just a tax loss, and then use that to offset your other income from your other businesses.
Man, that's golden, man. Like, the breakdown, I think that'll help a lot of people understand like how they can benefit. It doesn't matter. You don't have to be extremely wealthy to benefit. I believe just taking and getting educated and working with someone like yourself, man, to help a person understand, to make the best, take the best opportunities when it comes to investing, man, to be able to go to the next level, man. I really. Yeah. Man, this call here is it's been amazing, man. I learned a lot since I've been on. So I know before we end the call, one of my other questions, like, what are some of the recent changes that's happening in the tax space now that you're knowledgeable about?
Well, since 2017 to up to 2022, we were in 100% bonus, which basically means in that 1.2 to 1 million example that I was given. So let's just say out of that 1 million, let's just say $200,000 of it was considered 5-year or 15-year property. From 2017 to 2022, you was able to use, like, basically write off that full $200,000 in the year that you were able to put that property into service. Huge benefit for a lot of people. Now we're in this sunset period where that's going to phase down 20% every year. So as of 2023, we're now at 80% bonus in that situation there. So it may not be the full 200. I'm at the top of my head right now, where it may just be $180,000 that you can write off in that example. And as I tell most people, like, don't let the large numbers fool you. This can happen. This can work just as well for a $120,000 single family home as well, or a $200,000 duplex if you're doing smaller multifamily. So it doesn't really matter. It's just like, how does that affect you personally on your tax return from it as well. And there were some changes to the retirement regulations per the the Inflation Reduction Act, where you can now contribute more into your Roth, or be able to convert your any 529 plans you have with your children, if it's been held for a certain period of time, into a Roth. Big opportunity there for those who, like I said, for kids who, like, they know they're not going to college and they don't have another kid to transfer this 529 to. You can now kind of get that all converted over as well. So a lot of changes with that, where it's like, hey, they're trying to, anything we see with tax laws, like, hey, what are they trying to get the masses to move and do? And then with the retirement account, they want people to save to their retirement, not so much rely on Social Security and Medicare to be there, or to be a major component of it from there. And then 2021 and 2022, we were 100% meals. Business meals were deductible. We're now back to 50% this year. So just something to be mindful of. The 100% during that time was to kind of basically give a shot in the arm to the food industry, the restaurant industry, where, like I said, just people weren't going out for COVID, so a lot of restaurants got hurt. So that helped a bit, but we are kind of phasing back into 50% from there. So those are a few things to be mindful of if you're looking to still get large deductions from your real estate, invest out of retirement accounts, or put more into your retirement account, as well as just another business deduction that's going to be reduced a bit from what people are used to getting. And then we're kind of back to normal. Hey, you got your child tax credit. There was no advances, no stimulus, so none of that stuff to worry about for 2023 for the 2022 tax filing.
Man, that is golden, man. Look, you said something that I know we're gonna have to do a part 2, man, especially when talking about retirement and the benefits of that. So y'all make sure y'all get ready, because we're gonna have to do a part 2 with Larry, man, and talking about the retirements. That's something I would definitely love to dive into, man. But we coming up on our time. Larry, I really appreciate you, man, for coming on and sharing your expertise on this space, man. Is there any last-minute things that you like to say, any last-minute advice you would like to give our listeners that will help them with, their CPA work and stuff that they would have to do when they're investing?
Just make sure you're vetting who you're working with. Like I said, depending on the industry and all of that. I say if this stuff could be like, we get calls all the time for people who are leaving their current CPA, and it's like at some point you will outgrow the person that you have. Does it mean you need to leave them? Maybe not. Like, you may need some additional consultation to help supplement what your current tax advisor is providing you. But is basically know that as you grow, your team needs to be growing with you. Is everyone on the same page of knowing what you're trying to accomplish? And if you're not getting the consulting, the having the conversations and strategizing going forward, you could be leaving quite a bit of money on the table, or just not being compliant with certain things. So just make sure you're vetting whoever you're working with, get your referrals, and just make sure you're on the same accord with that individual or that company.
Man, that was golden, man, and that does make a lot of sense. It's definitely something that I've been thinking about. I have multiple businesses, but when it's stepping into real estate, I want someone that understands this space, man, so we can make sure we're doing it right the first time. So, man, that was definitely golden, man. Larry, I thank you for coming on today, man. Sharing with us, man. It was a pleasure. Like I said, we're gonna have to definitely do a part 2, man. And it was great having you, man. You could like to share your social medias, any way a person can get in touch with you. And I'm also going to put it in the description on the YouTube. But if you mind, share your information.
Yeah, hopefully the website to my link page, that'll have all my social media. But I'm on LinkedIn, Facebook, Instagram, Larry Pentathlon CPA. Try to make myself easy to find from that perspective. But yeah, even throughout this tax season, we're still taking on intro calls and consultation sessions where time is allotted for it. So yeah, looking forward to helping whoever wants to reach out and building from here.
Man, brother, I appreciate you, man. We already had our talk, man, and I'm definitely coming with you, man, and working with you, and I appreciate you for coming on and sharing some light on this space, man. And like I said, we're gonna have you back here soon, man. I appreciate you for coming, brother.
I appreciate it. You have a good one.
Absolutely.